Welcome everybody to this bootcamp. Today's session will be talked about financial plan. My name is Javier Colocho. I'm with the Young America's Business Trust Bootcamp Coordination. Today's speaker is Susan Ramadin. Susan, she's a program manager and part-time lecturer at the Business Climate and Innovation Program. Susan's passions to gain transfer knowledge resulted in several opportunities to gain knowledge. She received a partial scholarship to attend 2-week training in CMEs, Entrepreneurship and Innovation Management, at the Galilee International Management Institute in Israel in 2016. In this training course, the curriculum consisted of topics regarding management and decision-making marketing, financing, and contemporary issues. She also received a partial scholarship for 1-month training in monitoring and evaluation of the International Program for Development Evaluations Training (IPDET) in Canada. Susan also attended numerous workshops in the field of financial management, project management, procurement, change in management, and productivity. Presentations at the first IDB procurement fair and for several stakeholders are also common. Just want to remind you that this session is being recorded, and if you missed something and want to go back, you can also see it. Right now I'm going to make Susan the presenter so she can take it away.
Do you see my screen?
Yes, we can see it.
Okay. Hi, everybody. Thank you for the introduction. My name is Susan Ramadin Bansrapansing, and today I will discuss about the financial plan and the tools that you need to set up your financial plan. Finance, it's not a favorite thing for startups, but because you want to go in the field and start working, but having a financial plan is really a necessary thing to have in order to know what you are planning to do and where you gain your finances from. So today we will discuss the tools for financial planning that are the balance sheet. We will go through the balance sheet, the income statement, the statement of cash flows, financial ratio, and the break-even point. Good finances are important for running a successful startup, as they are the sign of a sustainable business model, and it makes it easier to pay bills and put money in your pocket. So the balance sheet, it's often described as a snapshot of a company's financial condition at a point in time, so once in time. The income statement gives the financial performance over a period of time, usually a year, a quarter, or a month. The statement of cash flows shows how changes in balance sheet, accounts, and income affect cash and cash equivalents, and breaks the analysis down to operating, investing, and financing activities. The financial ratios those analyses focus on 3 key aspects of a business that are liquidity, profitability, and solvency. The break-even analysis looks at the level of fixed costs relative to the profit earned by each additional unit produced and sold. The balance sheet. Of the basic financial statements, the balance sheet is the only statement which applies to a single point in time of a business calendar year. A standard company balance sheet has 2 sides. On the left, we have the assets, and on the right, the liabilities and ownership's equity. That's on the right, it's divided into parts also. The main categories of assets are usually listed first and typically in order of liquidity. Assets are followed by the liabilities. The difference between those two is known as equity, or the net assets of the company. And according to the accounting equation, net worth must equal assets minus liability. So we have the accounting equation. The accounting equation displays all assets are either financed by borrowing money or paying with the money of the company's shareholders. So the assets is equal to liabilities and shareholders' equity. The balance sheet is a complex display of this equation showing that the total assets of a company are equal to the total of liabilities and shareholders' equity. So in the accounting equation, any purchase or sale by accounting equity has an equal effect on both sides or offsetting effects of the same side. That means that you can purchase an asset with an asset, such as $50 purchase of equipment. So your asset increase with $50 of cash, so your cash decreases. Or fund it with liabilities or shareholder equity. So you purchase equipment for $50, that increases on the left side, and on the right side, you borrow money, so your liabilities increase, or you fund it with your retained earnings, so that decreases. So that's the basic in the accounting equation: what you own, what it owns, and what you owe. So what you have in your firm and how you have financed it. That's the basic of the accounting equation. Okay. So here is a sample of the balance sheet. We have the fixed assets. Those are like property, plant, equipment, investment properties such as real estate, patents, copyrights, goodwill, financial assets such as notes receivables, and we have the current assets. Those are like prepaid expenses that for future services that will be used within a year, accounts receivable, cash and cash equivalents. So that's on the left side of your balance sheet. On the right side, the liabilities, we have the liabilities indicate the amount of money a company owes to its short-term or long-term creditors. The total liabilities are divided into short-term liabilities, also known as current liabilities. The short-term liabilities are expected to be paid off within 1 year, while long-term liabilities include debt that are expected to be paid off over 1 year from the balance sheet recording date. So the day that you start with your balance sheet. For example, assume a nutrition company has total current liabilities of 5 million and total long-term liabilities of 20 million. So the total liabilities for that company are 25 million. The liabilities comprise of accounts payable, provisions, financial liabilities, liabilities and assets for current tax, and mortgage payables. So and then we have the equity or capital, the owner's equity. It should be calculated by summing the amount of share capital and retained earnings. and subtracting the amount in treasury shares from the sum. For example, assume a nutrition company has share capital of 10 million, retained earnings of 25 million, and treasury shares worth of 5 million. Therefore, the company has a total shareholder equity of 30 million. Okay. The listing of the balance sheet is based on what type of company you have. Sometimes you don't have everything that is listed here. This is just an example for your view to see how you can put it together. Okay. We also have, sorry, one moment. Yeah. Okay. The income statement. The income statement indicates how the revenues, the money received from the sale of production and services before expenses are taken out, are transformed into the net account. That is the result after all revenues and expenses have been accounted for, also known as net profit. The purpose of the income statement is to show managers and investors whether the company made or lost money during the period being reported. One important thing to remember about the income statement is that it represents a period of time like the cash flow statement, which we will do later on. This contrasts with the balance sheet. This is the contrast with the balance sheet because that represents a single moment in time. Understanding an income statement is essential in order to analyze the profitability and future growth of a company, which should play a huge role in deciding whether or not it is attractive for investors to invest in your company. The income statement summarizes a company's revenues, sales and taxes, sales and expenses quarterly and annually for its fiscal year. So the income statement is really necessary for your investors if you have or you want to take a plan to go to the bank, so they will check also your income statement, the balance sheet, and the cash flow. An attention point, income statements recognizes revenues when they are realized. So when goods are shipped, services rendered, and expenses incurred. With accrual accounting, the flow of accounting events through the income statement doesn't necessarily coincide with actual receipt of disbursement of cash. The income statement measures profitability, not cash flow. So in your income statement, it's not necessary that you receive the payments. If you have creditors or debtors, you already include that in your income statement. In the cash flow statement, you don't do that because that's based on the actual receiving of your money or your paying of the expenses. But in your income statement, you can also have payments that are not paid yet. So that's the difference with the income statement and the balance sheet. So as stated here, the income statement, you have the assets, cash or accounts receivable, created through business operations. We have the expenses. Assets are accounts payables consumed through business operations, and the net income revenues. We have here an example of an income statement. The income statements, in the income statements, we have the net sales. This term refers to the value of a company's sales of goods and services to its customers. So you see that at the top, the sales. You subtract the cost of sales, also known as the cost of goods or products sold, or for services if you have a services company. For a manufacturer, cost of sales is the expense incurred for labor, raw materials, and manufacturer overhead used in the production of goods. So these costs are directly related to the production of your goods. For wholesalers and retailers, the cost of sales is essentially the purchase cost of merchandise used for resale. So what you buy in, you put there as the cost of sale. For service-related businesses, cost of sales represent the cost of services rendered or cost of revenues. So that is what you receive from what you pay for getting that service. So when you have the net sales and the cost of sales, you deduct that, and then you get the gross profit. The gross profit it doesn't only simply represent the difference between net sales and the cost of sales. It provides the resources to cover all of the company's other expenses. The greater and more stable a company's gross margin is, the greater potential there is for positive net income results. So after you have the sales revenues and the cost of sales, you get a gross profit. Out of this amount, you will pay all the other operating costs, as stated here, the operating costs like selling expenses, administrative expenses, etc. So the selling general and administrative expenses, often referred to as SG&A. This account comprises a company's operational expenses. You have here a summary of some of the expenses that you can have in your company. You can adjust it according to what type of company you have, because if you are like giving lecturers, then you need to have a room to rent. But if you are a communications person, then maybe you do it like from home. So it differs based on what type of startup you have, what type of firm you have. The operating income. The operating income is when you deduct the selling, general, and administrative expenses from a company's gross profit. Then you have the operating income. You see here the income from operations. When you have that, that means that all the expenses are paid except from interest and income taxes. So you can have interest expense. This item reflects the cost of a company's borrowings. What you borrow, you need to pay interest for. Sometimes companies record a net figure here for interest expense and interest income from invested funds. So they totalize it. If you have given funds, then you receive, and if you are lending, then you pay. So you can totalize it and put it in here. The income taxes, as stated, the income tax amount has not actually been paid. It is an estimate or an account that has been created to cover what a company expects to pay. So then we get a net income. This is the bottom line, which is the most commonly used indicator of a company's profitability. Of course, if expenses exceed income, this account caption will read as a net loss. So after the payment of preferred dividends, if any, net income becomes a part of the company's equity position as retained earnings. So what you have as a sum for your net income will go in your balance sheet as retained earnings in the share equity section. Statement of cash flows. A cash flow statement is a financial statement that shows how changes in balance sheet accounts and income affect cash and cash equivalents, and breaks the analysis down into operating, investing, and financing activities. The cash flow statement is concerned with the flow of cash in and out of the business. This statement captures both the current operating results and the accompanying changes in the balance sheet. So, so the cash flow statement is, you can divide it in three segments: the cash flow resulting from operating activities, from investing activities, and from financing activities. The statement of cash flow, you have cash inflows. This is the money coming into the business. And the cash outflows, that is the money going out from the business. So for companies, you have the inflows when you sell goods or services. If you have assets and you sell them, you get cash inflow or when you take a lend money, you're borrowing, so it increases the inflow of cash. Or receive cash from investment by owners. And the cash outflows for a company when you pay the operating expenses, when you are planning to expand your operations, or you repay loans, or you pay the owners a return on investment. So those are the inflows and the outflows of cash. So the operating expenses, you see here the operating expenses, investing and financing. We will discuss it here. The operating activities. The operating activities include like the production, sales, and delivery of the company's product, as well as collecting payment from its customers. This can include purchasing of raw material, building your inventory, advertising, shipping, and shipping the product. So we have here like some examples for cash inflows from operating activities and cash outflows from operating activities. Investing activities. The examples are like purchase or sale of an asset. That can be like land, building, equipment, loans made to suppliers or received from customers, payments related to mergers and acquisitions. So you have here the cash inflows and outflows. We have the financing activities. Financing activities include the inflow of cash from investors, such as banks and shareholders, as well as the outflow of cash to shareholders as dividends as the company generates incomes. Other activities which impact the long-term liabilities and equity of the company are also listed in the financing activities section of the cash flow statement. So here you have it. What you gain as inflows also goes out. We have here the analysis of the cash flow analysis. When the operating, investing, and financing activities are positive, then you build up a pile of cash and you maybe want to purchase land or something. When the operating expense activities is positive, investing in finances is negative, then your cash is maybe used to buy fixed asset or pay your debt. When the operating investing activities are positive and financing is negative, then you the operating cash flow and sale of fixed asset will be used to pay down debts. When your operating and financing activities are positive and investing is negative, then the operating cash flow and borrowed money will be used to expand. Okay. The purpose of analysis: financial analysis helps users make better decisions. Like I said, you have internal users, your managers, the officer, and internal auditors. The external users, the shareholders, lenders, customers, they want to know at any point of time how your company is doing, do I need to invest, etc. So that's also a point to note. So the building blocks of analysis: if you are able to meet your short-term obligations and efficiently generate revenues, you look at the liquidity and the efficiency. For the long term, you look at the solvency, ability to provide financial rewards. You look at the profitability and the market, is what are the market expectations. The ratios: for solvency, we have the debt ratio, the liquidity, the current ratio. Efficiency is asset turnover, and for profitability, the return on equity. We will discuss now what the ratios are and the purpose of why you need to have those ratios in your financial planning. Financial ratios, they can provide small business owners and managers with a valuable tool with which to measure their progress against predetermined internal goals, a certain competitor, or the overall industry. That's also really to know who are your competitors or how is the industry involved or affected by these ratios. In addition, tracking various ratios over time is a powerful means of identifying trends in their early stages. It is important to keep in mind that financial ratios are time sensitive. They can present a picture of the business at a time that the underlying figures were prepared. For example, a retailer calculating ratios before and after the Christmas season would get very different results. Before Christmas season, the results would be high, and after that not, because Christmas, everybody wants to dress nice, so that would be you need to take that into consideration. In addition, ratios can be misleading when taken singly. They can be quite valuable when a small business tracks them over time or uses them as a basis for comparison against company goals or industry standards. You need to compare ratios to historical data and industry averages. That is really a necessary thing to do when you are looking at ratios. In general, financial ratios can be broken down into four main categories: the profitability or return on investment, liquidity, leverage, and operating or efficiency. And we will discuss now for the solvency, that's the debt ratio. It measures the leverage. That means the portion of a company's capital that is provided by borrowing. As you see, You measure it by the total debt divided by the total assets. A debt ratio greater than 1 means the company has negative net worth and it's technically bankrupt. Solvency ratios indicate financial stability because they measure a company's debt relative to its assets and equity. A company with too much debt may not have the flexibility to manage its cash flow if interest rates rise and if businesses conditions deteriorate. So, as stated here, it varies from industry to industry, but it should be around 50%. That means that the 50% of your total liabilities needs to be borrowed. If it's more, then it can be a problem for your organization. If it's less, that's better. The current ratio, that's for the liquidity. It measures the liquidity. It's also called the working capital ratio. It measures a company's ability to pay short-term and long-term obligations. The current ratio is mainly used to give an idea of a company's ability to pay back its liabilities, the debt and accounts payable, with its assets like the cash, inventory, accounts receivable. So the current ratio can be used to make a rough estimate of a company's financial health. So it's a cycle or its ability to turn its products into cash. Companies that have trouble getting paid on their receivables or that have high inventory turnover can run into liquidity problems if they are unable to alleviate their obligations. So the problem can be that if you have too many inventory, you cannot cash it always, and that can be a problem. So the ideal current ratio, it depends on the type of business you're in, but it should be 2-to-1. So the current assets 2 and the current liabilities 1. A lower current ratio means that a company may not be able to pay its bills on time, while a higher ratio means that a company has money in cash or safe investments that could be put to better use in the business. If you have too much cash, that's also not good because people think that then you are not doing anything with your money. So you need to also focus on the ratio. It's not that if it's really high then it's good. So you need to check that every time you are doing the ratios. The asset turnover, it measures the company's efficiency. By assessing a company's use of credit, inventory, and assets, efficiency ratios can help small business owners and managers conduct business better. These ratios can show how quickly the company is collecting money from its credit sales or how many times inventory turns over in a given time period. This information can help management decide whether the company's credit terms are appropriate and whether its purchasing efforts are handled in an effective manner. So here you need to look at when you purchase inventory and you cannot sell it, you cannot have too high inventory. So that's measured by the asset turnover ratio. Because like if you have a company that's selling a bakery store, for instance, and you are not selling all the cakes and cookies within the time that it's needed to, like it's like the expiration date is within 1 or 2 days and you are not doing that, then you need to look at the problems for that. Maybe do a marketing or something that people will come to your store and buy those things. So turn on sales and its purpose. It measures the profitability. The return on investment ratio, which is the ratio of net income to shareholders' equity, indicates a company's ability to generate a return for its owners. So it measures the efficiency. When your return on equity is rising, it suggests that the company is increasing its ability to generate profit without needing as much capital. It also indicates that how well a company's management is deploying the shareholders' capital. In other words, the higher the return on equity, the better. Falling return on equity is usually a problem. This means that it measures the amount of profit earned per dollar of sales. So how much money do I make with the amount that I have lent from my for my company to work as working capital. So it's evaluated within the appropriate industry. For every industry, you have like several indicators. It's not that it's given like the others. Yeah, here it's the how you measure it, typically between 15 and 25%. Then we have the break-even analysis. The break-even point is the point in which total cost and total revenue are equal. You have no loss or gain. In short, all costs that must be paid are paid, and there is neither profit nor loss. So the break-even point represents the sales amount in either unit, quantity, or revenue sales that is required to cover total cost consisting of both fixed and variable costs for the company. Total profit at the break-even point is zero. Total profit at the break-even point is zero. It is only possible for a firm to break even if the dollar value of sales is higher than the variable cost per unit. This means that the selling price of goods must be higher than what the company paid for the good or its components for them to cover the initial price they paid, like the variable cost, as stated here. Okay. For example, a business that sells tables needs to make annual sales of 200 tables to break even. At present, the company is selling less than 200 tables and is therefore operating at a loss. As a business, they must consider increasing the number of tables they sell annually in order to make enough money to pay fixed and variable costs. The main purpose of the break-even analysis is to determine the minimum output that must be exceeded for a business to profit. The break-even point is one of the simplest yet least used analytical tools. Identifying a break-even point helps provide a dynamic view of the relationship between sales, cost, and profit. So for startups, it's really important to identify what are my variable costs, what are my fixed costs. In order to do that, you will have your break-even, that is the minimum that you need to produce or sell to be break-even. No profit, no loss. And in order to gain profit, then you need to start selling or producing more that break-even quantity. So that's why it's really important to know or to calculate what your break-even point is. So this is the formula for the break-even point. We won't discuss it, we will just go. Here we have the analysis. Here you see the units of production, total revenue and cost. When they come together, we have the break even. If everything lower than that is the loss area, and everything more, you have the profit area where the revenues or your net, you start to receive profit. We have an example. A company that sells one type of surfboards. The following data are available. The selling price is 625. The fixed costs are 450,000. The variable costs are 250 per board. So how many boards need to be produced and sold by the company in order to make a profit or a loss? Then the formula, when we use the formula, we have the fixed cost at 450,000. The price is 625. The variable costs are 250. So if you subtract and divide it, you have 1200. So the company needs to sell 1200 surfboards to be break even and gain profit. And to gain profit, this company needs to increase the number of production. If the business does not think that it can sell the required amount of units, so the 1200, they could consider the following options. So if you are not able to produce more than 1200, there are some options that you can follow, like reduce the fixed cost. This could be done through a number of negotiations, such as reductions in the rent, or through better management of bills and other costs. Reduce variable costs by, for example, finding a new supplier that sells tables for less, so your variable costs are lower. Either option can reduce the break-even point, so the business need not sell as many tables as before and could still pay fixed costs. So if you can manage one of the reduce the fixed cost or the variable cost, you don't need to produce the 1200, but you can still gain a profit. So that was my presentation for today. I hope that you enjoyed it. Thank you very much.
Thank you very much, Susan, for that presentation, and very informative. I think you really hit the spot on every aspect of the financial plan, that it's very important for our competitors to understand, really, in order to get their company in a good financial position. And right now we're going to open the chat for any of our viewers that have any question about the presentation. You can just type on the chat your question. I will read it to Susan, and she will answer any questions that you may have. Thank you again, Susan, for that. And also, I wanted to remind everyone that this presentation is being recorded and will be uploaded to the YABT website later on this week. So you can go back and revisit, pause, or just clear any doubts that you may have. We're just gonna give a couple of minutes if any questions comes up.
Yes. I'm waiting.
Susan, if you can you give our viewers your contact information, like email, in case they want to contact you personally?
Oh, okay. I'll put it as an extra slide.
Yeah, sure. That would definitely help.
Only my email?
Yeah, I guess your email will be fine if
Okay.
anybody wants to contact you.
Do you see it?
Yes, we can see it.
Okay, yeah, that's my email address.
Perfect. So, yeah, I guess that is, yes. Okay. I guess that will cover it. And, well, thank you for our audience being here and listening to this very important part of the TIC Americas. And thank you again, Susan, for joining us. And
Thank you.
yeah, we'll be in contact. Thank you very much.
Yes. Okay.
Have a good day.
Bye.